Here we go, folks. Here we go.
Right, ready to go now.
Technical difficulties, folks. Welcome alive to our webinar. It's been the first webinar we've done for quite a while.
Yeah.
And the first one we've conducted in Teams. So just getting used to the platform. We use Teams often, but first time we've used it for a webinar. So thanks a lot for joining us tonight or whenever you're watching this. We've got a Q&A here. If you guys can just maybe drop a little comment that you can hear us, you can see us, and yeah, you're ready to go, and we'll jump into tonight's presentation.
Also, they can see the...
We'll see a thumbs up there.
Can they see that?
I hope so. Can everyone see the slide deck? Present in Teams. I've got to... Where does it say? Oh, there we go. Where do
I... Screen here. Okay.
Here we go. Were you in IT in the previous slide as well?
And then there's questions and there's loaded questions.
I think you.
No, I'm just trying to make that full screen first.
Oh, just push it in the corner. Oh.
That's all right. We can work through this.
So I think if we start a slide show from the beginning.
Minimize that.
Minimize that down a little bit.
And then share.
Then we're going to share it. This one here. I think we're good to go, folks.
Got the thumbs up.
Got the thumbs up. If you guys can leave a comment, maybe just drop us a comment in the discussion box so we can see that the comment section's working and we can get the show on the road for everyone.
You learn something new every day, Nate.
I'm always learning, you know. Like I feel like here we go. Here we go.
Matt, how are you?
Josh, good, Josh. Yeah, fantastic.
Good. I reckon we kick it off.
Cool. Thanks for coming online.
Thanks for having me, Nate. It's always a pleasure. It's
been a while since we've done a webinar. Yeah.
Yeah. I mean, we did the live for the budget, which was a nothing budget, but I think this should be a bit more interesting.
Put together a slide deck, you know. Like it's been a while. Slide decks we put together for these. These are been doing some events, live events lately. So everything's cool, eh?
Yeah, I think it is. We'll change it up.
Rid, I guess if you want to give a bit of an intro to yourself and what you do, and yeah.
So to everyone who doesn't know me, my name's Ridhwan Hannan. I'm the main tax advisor, along with a couple of others at One Path Accounting. We deal with a lot of property-based clients, small businesses, individuals who are trying to get their time back, Nathan.
Yeah.
And trying to be a little bit independent from everything that they do. Yeah, so we deal with a lot of clients. I'll probably say we deal with a lot of property clients, more than anyone probably in the country, in terms of who we deal with specific with property. So we cover everything. So in terms of clients we're trying to acquire, who are in a property portfolio, who are looking at different structures to be able to acquire property through, and even for some clients who just are on the the lower end of the journey trying to kick it off, we deal with everyone in between. So we like to sort of pride ourselves on the fact that we do everything property related and more, but definitely those clients who want to build that big portfolio for themselves, we've kind of seen it all.
Yeah. Beautiful. How long has it been since we've been working together?
It's been 13 years.
13 years, huh?
Yeah, 13 years. Yeah, so it's
best 13 years of your life, huh?
Yeah. We moved to 2BC to be fit.
That's it. Good.
Tell us what we're talking about tonight, Nate.
So there's two parts to tonight's presentation. We're going to talk about self-managed super funds, which a lot of people need to know about. Everyone needs to know about a self-managed super fund, especially in the world that we're living in today.
Sure.
And the second thing is that we're going to be talking about trust structures, and a lot of people talking about how to finance their way through trust structures at the moment. And yeah, you're going to answer lots of questions for people.
I think it'd probably be safe to say that I think we've talked about this probably more than anyone. It's now flavorful. It's in the media world, it's in the buyer's agency world about trusts and super and leveraging and getting a bit more access with the banks. But we've been talking about it for quite some time. So I think it's good for us to jump back into that conversation and make sure everybody knows how it actually works, rather than just being, flavor of the month. Understanding how it fits in with your overall property journey, actually building a portfolio, not just getting from property 1 to property 2, but property 1 to property 10.
Yeah.
So we've sort of developed over the years a system that works, and it does intersect with the banks and how they operate as well. So I think you have to have timely advice as well, not just have, I think this works. So let's get into it.
Cool.
So in terms of super funds, if you guys can see on the screen, a lot of you I can see on this invitee list would have a self-managed super fund. Nathan, you have a self-managed super fund. I have one.
My self-managed super fund, Red, I think was before, like they say that Australia was founded in 1788, right? So 1788, I think it was, like 200 something years ago, right? There was people here
before
that.
1770.
70, they said 70, whatever it is, right? I feel like I set up a super fund before that, right? No one had a self-managed super fund back then, right? It was like I was the captain cook of super funds.
Super fund, yeah. All the good parts.
Yeah.
Look, self-managed super funds have been around since the 90s, right? The early 90s. And back then they were more a tool of very sophisticated type investors, people who understood it. And it sort of was born out of the fact that people had the right to manage their own super. Obviously, Paul Keating brought in super in the 80s, and it was then handed over to many fund managers. And then people thought, like we're having the conversation now, I'd like to manage my own pension and my own retirement. And I always use a bit of a line that I've stolen from you, is that the only person you can trust is the guy that you're looking in the mirror when it comes to your financial retirement or independence. And so self-managed super funds typify that from a structure point of view. So as you see on the screen, it's basically a private superannuation fund managed by its members and or trustees. So trustees are effectively like the guys sitting in the city at all the other big super funds.
That you never see.
You see the buildings. You see the buildings, but you never see their faces. They're managing, they're investing, they're effectively giving you guidance on what you should do. Obviously, with the self-managed super fund side of things, you're responsible. You've got all the sort of locks and keys on your name about what you're doing. You control the fund. Yeah. And what we say is that you have control but no access, i.e. you can't pull it out for yourself, you can't lend it to your mates, you can't do anything like that. You're in a position where you're basically looking at a property, you're looking at an asset type, you're looking at an asset class, you can invest in that, and you'll be in a position where you'll be held accountable for any investments that go wrong, i.e. you're the person who's in charge, and you'll be in a position where you have to annually report all your activities to the ATO. So it's not for everyone, and that's the honest truth. You need to be on top of the management, but a lot of our clients have multiple properties, a lot of different structures, so they're kind of used to the paperwork. And I sort of say in the self-managed super fund world, the first 2 years are your hardest, right? The first year to set it up, it's long, it's winded, you're setting up bear trusts, you're doing all these things. And the first year of paperwork is an avalanche, right? Yeah. But after you get through that first 2 years, it's difficult. It's kind of like the gym, right? Yeah. First couple of sessions, first year may be very difficult, but then it starts to become something that you can't live without.
Tell me about that, Ridhwan.
No, I'm too weak too. So I think it's really important that people understand that a self-managed super fund, as a disclaimer to the start of this whole webinar, is that we're not recommending everyone should have a self-managed super fund, but knowing something about it, I think, is important, especially what's happened during this week. You've seen that super funds have been in the news. We will come to that later. And they've been in the news for the right and wrong reasons. I think it'd be safe to say.
We wanted to do this webinar like 3 months ago or so, and we didn't do it. We just have to plan all this stuff. And when we're talking about it like this, there's certain times throughout our lives where we see there's great opportunities and there's very risky times. And we saw that in February 2020 when, they closed the world down and what happened. And we saw the time that occurred prior to that. And we've seen certain times where, like if we go back to February 2020, people's super funds dropped by 40%. The stock market's dropped by 40%. Last week, the Dow Jones looked like crypto, right? Yeah. It was down 12, 15% in a day, up by 10% in a day.
The futures were down another 10 after the first day.
Exactly. And, what's that doing? The currency's out there because you're not just hedging in, some share market. You're hedging against bonds, other types of derivatives, all these. Who's seen, what's that show, The Big Short, right? The dog shit wrapped in the cash, right? It's a big Ponzi scheme. It's my view of super funds out there is, and I will talk about it like this. I guess it's a fun part about watching the video with me on, because I say it's funny as it is. We've all seen Wolf of Wall Street, and you see those people, right? As a kid growing up, your parents say, don't trust a used car salesperson, don't trust a real estate agent, don't trust the insurance salesperson. To be an insurance salesperson, you have to be a financial advisor. Those people on Wolf of Wall Street are the same people that are playing with your money in your super fund, and that's what's happening to it, right? You have no control over it. People in the start of February 2020, the stock markets crashed and people's super funds crashed 20, 30, 40%. And then they came back six months later and they go, oh, well, I had 150 in there, went down to 75 or to 85 or whatever. And now it's back to 150. So, they did a good job of recovering it. I'm like, hang on a second, you've had a year worth of contributions, so you've had no growth on it, and inflation made everything double. And we're now, people got robbed of their wealth, and you couldn't control anything to do with that. The question I asked everyone at the time was, who's your super fund? How much do you exactly have in there? And what's it invested into? And what did they do to stop any losses? And no one could ever give me the answer. As soon as they could answer one of those questions, I'm thinking, shit, you got $250,000, you've got the grubby little bits on it.
Yeah, look, I think that's a fair question. And I think those questions are ones which many people give you answers to. However, I think some of the fundamental parts of those questions, if you zoom out a little bit, is who is managing your money? And if it's going to be invested, who makes that decision, right? And what's the motivation for those decisions? Now, to be fair, retail funds have probably done year on year for the last 10 years, right? Probably 8 to 7, 7 to 8, probably in a top end scenario, 12%, right?
So they kept up with inflation.
So they kind of say, look, we made 10%. And I don't necessarily think that's a terrible situation. However, and I think the however part of it is that if you look at what happens, and I think I sent it to you this week in terms of they did a stock market versus property market analysis for the last 5 years, right?
Yeah.
They did that post-COVID, right?
Yeah.
But they said, had you actually gone and mapped out your share portfolio just 8 months prior to that in 2019, the overall returns would have only been 8.6%, right? Because they went down so much, Nathan's point, they went down by 30%, for example. They took their time to creep back up. Obviously, we saw what happened with the tariffs last week. I had clients who rolled out the week before the tariffs because they were doing a super fund. So theoretically, just their movement from their super funds into a cash account with Macquarie Bank, for example, who we set up with, that saved them 15%, right?
Yeah.
So I had clients who were about to buy property and they were like, well, I'm grateful that I actually moved it out. It wasn't my fault. It wasn't any sort of crystal balling I did, but it just happened to be, timely. So even this webinar that we're doing, we didn't time it with all these conversations and all these articles that we've got. It just happened to be there. So I think some of the control element that you do get back is really important. If your overall consensus about how you're going to retire needs to be squarely with you, right? And I think that's the fundamental part that I look at. Again, it's not for every single person, and some people do very well in retail funds, and some people do extremely well in, sort of tailored retail funds. You can get wrap products now, but there are some limitations to that in terms of what you can buy.
Yeah.
Come to the next slide.
Someone said here the chat section is disabled. The Q&A, post in the Q&A, because then we get to see. Sometimes people will put in their personal information and not realise it'll go to everyone. So this Q&A is just a closed one that we get to see, and we can answer the questions for you from that. So
so again, what we were talking about, that timely. Again, this webinar was planned a couple of months ago, actually more than that. And this week you would have seen, it wasn't everywhere in the news because of obvious reasons. They don't want to run on the banks or the super funds as such. But Australian Super and another notable super fund had a data breach, and there were people who actually lost money. I think in the article here, there was a collective members had 500,000 taken from their accounts. I don't think the actual initial amount of 500,000 is the problem. It's how they got into it, and then how do you actually empty an account that quickly? Because the way the super funds work from a retail perspective is it's all invested or partially invested, right?
Yeah.
So that means that you need to be in a position where you're looking at multiple funds, looking at the ability to be able to withdraw, looking at the ability that you've got to move it to somewhere else. And we do rollovers all the time.
Yeah.
It's very difficult to do, right? You see they block those rollovers quite frequently.
I always say, you'll see the level of Ponzi scheme your super fund is the day you try to set up a self-managed super fund. Because the amount of red tape that's there for you to overcome to be able to get your super, they don't want you getting it out. They don't want you because you're taking liquidity out of the market. And I do always think every time there's a recession, they keep increasing the super contribution because then it's just, push. Oh, stock market at all-time high. It's like, why? Because you just siphoned and forced, and third line forced more cash to go into these sorts of entities.
Yeah, I think you brought that up in one of the webinars or the lives that we did, and Action picked up. It was a good pickup in the sense that you're mandating more and more money to go into super world, which is good because people have got to retire, people are living longer, and all those type of things. But if the money's in there and it's getting compound interest or compound returns, then theoretically you shouldn't have to increase your level of input or your level of contributions.
Yeah.
You should organically grow and catch up, right?
Yeah.
So you made a really good point there, one that I didn't think of. So it is important. So for those of you who haven't actually checked your super fund in a while, and that's one of the things that we do when we go through clients and the financial planner that you have the podcast with, Fig, he's the other financial planner that we use now. So when we go through a consideration of whether our super fund should be set up, you'd be surprised, Nathan, how many people say, I have no idea how much is in my super. Right? I had a client walk in today and he said, hey, by the way, do you have anyone who can help me with our super fund?
Yeah.
I brought it over from the UK. It was £261,000, about $500,000.
Crazy.
And he gave it to some advisors. I won't say the name. And he got a notification this week. Those advisors have gone AWOL, right? And so he's a guy who is nearing his retirement. He's in a position that, and AFIC is involved. AFCA is involved and ASIC is involved. And
AFIC is a financial planner. AFCA is a financial regulator.
They're all involved to try and work out what's happened. And it's really important. So if you haven't, jump into your super now, make sure you're not one of these people, and God forbid you are, we will certainly love to help you out to make sure that we can, get any lost money back for you. But it is really important you check your super fund. But I think I wrote the notes is how safe is your super, right?
Yeah.
The reason that you're giving to these big, fund managers is that they're safe, right?
Yeah.
It's kind of like putting it in a bank. But if you've had a data breach here, whether it's Optus, today there was one, Hertz came out, Hertz car company, there was another one. So all these things are really risky. Obviously B.Invested and OnePath are not free from that type of data breach, but we do our best. We're small businesses where, we're trying to do our best. So just got to make sure that you understand that your super is with someone, make sure it's protected. And I think we will get to it. But the one beautiful part about having a property, Nathan, you can't liquefy it easily.
There's lots of benefits. I think we've got some slides or like there.
Well, there you go.
There you go. Literally, there's a slide there, right? I haven't even seen the slide. We're just trying to get to the slide and it's the timing. So, with it, I always think if you don't hold it, you don't own it, right?
Yeah.
How many times do we see these people, they get into property funds, they go, I've invested my money with a developer, I'm going to get a 10% return per annum, 33% return per annum over 3 years. We heard of one today, someone invested and they lost their money. And it's something that, looking at the funds, right, you don't own the control of it. They could be doing anything inside of the super fund. You want to physically own it. If you're buying gold and silver, you want to take the physical possession of it. You don't want an ETF of it. If you're taking crypto, you want to have custodian over the actual crypto and the private keys, not leave it on the exchange or whatnot. So I think the importance of controlling your own assets, controlling your own wealth, especially in a time like we are today, it's never been more important, especially to what we're seeing in the future. And just thinking about it, I don't know if we've got any slides for this tonight. One of the benefits, I actually just want to throw out a disclaimer before I go into this one. We aren't financial advisors here today.
Unfortunately not.
This is a general discussion, not a financial advisor recommendation per se. We can help you facilitate all this. We've got financial advisors that we
Connect
trust.
with everyone.
Yeah, everyone's there. But if someone had 200 grand in their super and then to set up a software, if they were to have it there, they got 5% return on it. That's 10 grand that you're going to have your super fund grow. So it goes from 200 to 210. There you go. It's been pretty boring, right? But then if you took that 200, I'll just make up some numbers and bought $1 million worth of property, and that went up by 5%, well, then your $1 million is now gone up by 50 grand. So instead of it going, 200 grand goes to 210, now your 200 has gone to 250 because you'll be in that net worth position, you can leverage inside of that super fund. So there's many benefits when it comes to setting up a super fund.
Yeah, absolutely. And look, when we do our super sessions, we go through that, and it's the same mechanism that you have in your own personal name. Virtually everyone here has property in their own name, right? It's either saving or using that leverage, so you get those amplified gains. The same premise inside of your super fund, that yes, non-levered gains also work, but levered gains mean that your cost of capital is there, and you've got to pay a return on that. But the amount of exposure you get to the asset class increases rapidly, right? So, we've done many, scenarios with clients where you go, okay, well, if you just make your contributions and you were to get an 8% return over the next 10 years, 20 years, 30 years, what does that look like if we compared it to it the same inside of property and levered returns, right? So again, as Nathan said, it's not a case where you have to have a super fund and leverage your super, but it's just about what you're going to end up in retirement with, right? So I think it's important that people understand, yes, your super is safe generally with the retail funds, but if these type of transactions, data breaches, market corrections occur, then safety in and of itself, from a definitional point of view, is how safe are your funds, right?
Yeah.
Like we saw during GFC that overnight we had corrections based on the exact same asset class. It was just a rating that changed. Went from AAA to triple C or triple B, and then suddenly the value's gone, right? So we've seen it before, we've seen it in different other things. And again, inside of your super, you can have equities, but maybe those are equities that you're comfortable with or that are recommended, or there's an exposure or a risk mechanism is put in place to make sure that it's not all there, right? So, a lot of people from the equity side will say, hey, invest in ANZ.
Yeah.
Right? A financial planner told me this. He goes, if you're happy to invest in ANZ from the share point of view, why aren't you happy to take their mortgages? It's the same thing.
Yeah.
Right? You're just making money off one of the potential investable assets, right? So it is one of those things where in a liquid format or a cash format, which is on the screen, then there can be rapid changes to your balance, right?
Yeah.
We've seen it during GFC, we saw it during COVID, and we now have seen it during the tariff wars, right? Where clients who might have 350,000 suddenly have 280,000, right? And that can be the difference between 1 or 2 years worth of retirement or how fast your retirement comes up, right? So in reference to this, yes, property is a more illiquid asset, but if you're looking at pure safety lever, it's a much more difficult asset to be able to move or defraud in what happened, overnight with some of these unfortunate superannuation holders. So super's been in the news for a number of different reasons this week. And I had a conversation with Nathan offline about this, which was, the Liberals have come out and basically ratified what their predecessors were considering doing, which was opening up the super funds to be able to have access to affordable housing, or trying to create more affordable housing, I should say, coupled with, and this is a different, webinar potentially, but coupled with changes to how interest on your PPOR might be reduced or might be tax deductible.
Backing up, like this is just an article. We have some articles here to run through. We're very politically atheist, right? Because we understand that the actor that's placed on the stand to talk about they're being placed there, being very politically correct here, and they're all going to lead to the same outcome. Yeah, and the whole financial system of super funds was created from the recession we had to have back in 1992. They created a little Ponzi scheme called super. Then they start breaking down the family unit. There's certain things that they do to get more taxpayers out there. There's more communicate, more entry points to the system. This is just another tool that they're using. They're going to weaponise super funds. They're going to weaponise, the way that people like the first homeowners that get the 55 grand worth of tax deductions via buying a property as a first home. That is very interesting because they haven't talked about it like that. The 55 grand that you're about to claim over a period of 5 years, that's a 55 grand first homeowner grant now, not a 7 grand homeowner grant that's in the early 2000s. So they're just weaponising the bubble bigger and bigger by what they're doing, and it's just going to direct more funds. So
look, for me, on that previous slide, it's the question really is that it goes back to the slide even before that, is what's the purpose of your super, right?
Yeah.
If the purpose of your super is to remain safe, remain in this position where it's going to grow and provide a retirement, they're saying they might give you 50,000 from your super for your first homeowners, right?
Yeah.
Nathan, what happens when that building approval collapses again because we have supply side constraint? Because the tariffs have gone up, and the builders go inflation, the whole works, all these different,
the bubble gets bigger.
Yeah, the problem gets bigger. They go, well, actually, Nathan, it's now 100,000 that you can take out of your super.
And then suddenly all the properties are bought for 100 grand, it's irrelevant, right?
So my thing is that they've got to choose what it is that they're trying to help you on. Are they trying to help you retire, or they're trying to help you buy a property, right?
Yeah.
The reality for me is that I think they've run out of ideas, and so super is a very, very uncreative, lazy way for them to be able to, push down this housing prices that we have.
So yeah, whichever way you go, like here's an article that's interesting. Whichever way you go, they're just pushing more liquidity in that system and inflating it to be bigger.
Yeah. So this slide is what I was referring to. Is the super? Is it for my pension? Right. If it's for my retirement, why are they allowing me to use more? Because Nathan, they all say you're the problem. You're the dude who owns all the properties.
Well, they've got to find somewhere to the common enemy for everyone, right?
And so
communism.
And so if you're meant to retire for your super, but you didn't get a leg up when you got a property, right?
Yeah.
When does that run out? Like, the super going to get drained before you get to retire, or when your kids get to retire? Like, how does it work, right? So I think the government's doing itself a disservice by opening this door, because it doesn't help housing pricing. The only thing that helps housing pricing is supply.
Helps get into more debt, which helps them. It's just like any Ponzi, right? The people that start the Ponzi benefit the most, right?
At the start of the Ponzi.
Yeah, at the start. But then the Johnny come later is the worst, with the ones that come in later on, and it's making this problem bigger and bigger. So you buy a property for 200, you sell it for $1 million. You made 800 grand, but the guy that's buying it for $1 million has to go get a loan for that. And then you get paid. So that money is now being capitalised by creating that profit and taken out of the system. Someone's sitting there with $1 million in their pocket. The other person's now sitting there with $1 million landmine strapped to them. That's like, and then it's like the next person will come and go, okay, well, we need to keep the bank growing, so we'll just have to keep printing more money. We'll find another way to shift all this around, and suddenly you're getting 200 grand out of your super to put into a first home deposit, and then the price of that could go up to $2 million. And it's like, okay, the last one got out, and the one that was right at the start really benefited, right?
Yeah, no, absolutely. Like, I mean, look, disclaimer, I wouldn't consider it a Ponzi, but I know.
No, I'm saying the whole financial system's a Ponzi.
I agree.
Not the super, not the property.
I agree with what you're saying in terms of timing. It's all about those different ebbs and flows. But for me, there's a silver lining in this statement.
Yeah.
Because for years and years and years and years,
I like silver.
The regulators told us that property is a problematic asset for self-managed super funds. But here you've got the government, or the incumbent government, or potential incumbent government saying, hey, we think property is so sound, crack open your super, take 50,000 out and do it. So for those people who often are anti-property, anti-superannuation and property, well, here you've got an actual incumbent government saying to us, well, this we think is a relevant asset, because they're not necessarily going to let you take out your super to lose on a property.
Yeah.
They expect the property to grow.
Yeah.
Right? And I think the way that they caption it is that they think most Australians, taxpayers, homeowners, their best investment is their own home, right? So effectively, they're strapping super to property in this world.
Yeah.
What we've been saying for over a decade is, well, super and property, those are two compatible activities, right? And so I think for us, it's a good, for me anyway, where we speak to financial advisors, buyers, agents, whoever it might be. We never promote property in that regard for super being the only asset or a single issue asset. We say it can feature. It should feature as part of your mix, right? Yeah. So for me, it's actually a good silver lining and a little bit of justification for what we've been doing.
So one thing I had to skim over the slides, because it's your slide that came together with today. The one thing that we didn't have any specifics. I'd love to bring the whiteboard over there and start drawing it, but we're not going to do that. But one thing that I see is like just getting back to what part of your life is super for, or where does it fit in, right? A lot of people just think, oh, I've got 200 grand, I'll have 200, 300, 400 grand when I get to retirement. But what about if you have your super up and you go, okay, what's my overall strategy? My overall strategy is to buy 10 properties and retire today. I'm 40 years old or whatever. Okay, so you get 10 properties, you're 40 years old, and you're getting $100 each one. You've got $1,000 a week, you've got 50 grand a year passive. Happy days. That's a good starting point, right? But then how do you pay out all the debt of that? So some of our investors will go, okay, I'll go and buy 4 properties by super. And let's say they've got 300 grand, 200 grand, 300 grand. They buy 4 properties, 1 million, 1.5 million that they spend. They wait till they're 60. So the properties go up and double. They might go from 1.5 million to 3 million. And they might go from 3 million to 4.5 million. So it'd just be like collectively. Collectively. So it might be a 300 grand property today, and then over the next 20 years it turns to 900 grand. And it's very humbling sort of numbers to be talking about there. A lot of those properties used to buy on the Gold Coast, Perth, Hounsville, Gladstone, wherever, they've all double, triple, quadrupled in price. So if we use that as an example, someone had 1.5 million turns to 4.5. Over that 20 years, they pay down the debt gets removed. They're now sitting there at retirement age with 4.5 million worth of asset. What are the tax benefits when you retire? Well, what's the tax rate for retirement?
So, pre-retirement, long-term capital gains tax is only 10.3%.
Yep.
Under current legislation, in retirement, or if you're met retirement or you met all the conditions of retirement, it's 0.
So if you're 65 and you
fully retired,
you can take it all out.
You can. I mean, obviously, you'd like to remain in a tax-free environment. So I think what you're sort of edging towards is that you have some mechanisms within the super environment to extract tax-free cash.
So if someone was here at 30 today, 40 today, 25 today, whatever, right? And they bought 1.5 million worth of property in their super, they turn to 60, they sell it for 4.5, have no debt left over in the super. They've got 20 properties with 200 grand loans in their personal name, so they've got $4 million worth of debt. They sell all the $4.5 million worth of asset in their super. They're at 65. They pull it out, pay no tax, take their cash, pay out all the debt in their personal name, and they've got 20 properties owned outright, unencumbered by using that vehicle.
So, as a situational example, absolutely.
Just as an example, folks, not as a...
We are at a point where they're trying to do 2 negative things in super because the pie is so big. So super is about $4.1 trillion at the moment, and they are aware of that. They're acutely aware of that. It's another taxing pool. So you've got transfer balance caps at the moment, which are about 1.9 million, call it 2. So the most you can have in a tax-free environment at the moment is 1.9 million. But in answer to your question, if you have 2 members and you had $1.9 million each, it's 3.8. You could theoretically take out that 3.8 and you go up and clear your personal debt, right? Now, the vagaries of that, obviously, we've got financial planners who can assist you with that. But what's important is that during your working career, most people are hyper obsessed with tax to a fault, in my opinion, right? Some people don't invest because of tax. Some people don't sell because of tax. Some people don't do anything because they're paralyzed because of tax. Tax is a fact of life. But if you're looking at what you see online, on Insta, on all the other socials, where people are setting up in the Cayman Islands and this and that and LLCs and the whole works, well, you've kind of got that right here in the sense that if all you're trying to achieve is to get the most blended tax or the lowest tax environment you can have, super should feature. You could theoretically sell a portion of your super fund to pay out your personal debt, or you could pay out personal debt by selling those properties, paying some tax, making contributions into super, which is the tax effective, close towards a retirement, and then having the bulk of your wealth inside of super tax free.
So if you're 60 years old, how much could I contribute to super? Let's say I sold a property for 300 grand profit, and I've got to pay tax on that 300 grand profit. How does it work with transferring that money and saving tax from selling an asset in your personal name and dropping into super?
Yeah, good question. So there's a couple of different ways. So number one is that if you're 60 and still working, you're free to contribute to super. There are some limitations after you stop working and depending on your age.
What's the maximum amount you put in?
So in a particular year, the maximum global cap you have at present is 30,000. Right?
What about if is there not bonuses where you're selling an asset to?
No, unfortunately, there's not. However, there's, for a lot of people, we call these unused concessional caps. So let's say, for example, in a previous 5 years, you've only contributed 20,000. Each of those years, you have $10,000 you could have contributed more.
Yeah.
They'll let you bring forward that for 5 years. So in the year that you've made a capital gains, you can say, okay, great, I'm going to put in an extra 20 on top of my 30, which is a global cap. So you've got to work it out with your accountant, depending on what work's paid for you. But you might have 40 that you can put in. That will reduce your tax bill, right?
Yeah.
And that's important. But what's also important is that you might have spare cash from that sale after paying debt. You can put in up to $120,000 a year into super, no tax on the way into super, and when you pull it out, there's no tax on the way out. So that means you can actually load up your super by pushing more into there whilst you're young to then pull it out when you're of age.
And just being mindful, right? Like if you're 20 years old or 30 years old, is putting the money into super the best thing to do? We're not here to give you the answer to that, but you've got to be thinking, if you can't touch it for another 30 years, is it the smartest thing to be putting in there, or is it better to be using it under another form of SPV, special purpose vehicle, which you could use? So,
or you can do what a lot of clients do. They look at their global wealth and they include super and they mobilize their super. So they go, look, I need, as a number, I need 12 properties paid off by the time I'm retired. Super features in that, right? And so they buy 5 or 6 properties in their super fund, set and forget, let it go.
Yeah.
And then they get to a point, which we've done for a couple of clients, or you've done for a couple of clients, they might get closer towards retirement and they might have 3, they sell 1 and buy another 3, right? So they quickly can mobilize those additional funds that are sitting in super, or the gains which have come in through super. So I mean, on your screen, you've got investment flexibility. You've got properties, yes, shares, yes, cryptocurrency, gold, silver, physical, in kind, gold and silver, wine. Yeah, so the answer to that is yes, but it's
can't drink it. You
can't drink it. You can't even keep it in your house, right? You've got to keep it at a cellar.
Well, some of the alcoholic is probably good to that. I don't drink. We don't drink. Right?
We don't drink. So,
what about someone wants a race car? I've heard people buying a race car and they're like,
not recommended, right? Collectibles. If that race car is a collectible item, can't stay at your home. It's got to be kept somewhere else. It's got to be stored, like at a Kennards or something like that. It's all pretty tight when it comes to that. But
you store it at your mate's house?
You can't store it at your mate's house. It's got to be an actual. It's got to be an actual physical type, business.
Would that be made over to a storage facility?
That's fine. If you get a receipt off him, it's okay. But yeah, so I think if you're looking at 99.9% of people are in shares, property, crypto, and long-term ETFs, long-term income funds, right? So term deposits or whatnot.
There's a lot of benefits if someone is a business owner and they buy their office.
Yeah, look, it's a good one. So commercial property is the one exempted property type where you can actually interact with your super. So if you buy a resi property, you can't rent it out. But potentially, if you're doing an arm's length, family members can rent it out as long as it's all clear. But commercial property, like where you're in, Nathan, your commercial property here, you can actually occupy it. So your business can occupy a super fund commercial property, and that could be mezzanine, that could be commercial, that could be mixed-use commercial, like some of the high street, main streets that you have, like St Mary's, that type of stuff, where there's commercial on the bottom and then resi on the top. That's still acceptable. So mixed use. So there's a lot of options in regards to within the asset class of property. You can do it. You can buy storage units, garage units. You can garage spots even if you'd like. I've had a client who had about 6 storage units. It was a bad sell in the end, but the income was good on the way in. So yes, it's very flexible in that regard.
What's the risks?
Risks. The big one for me is compliance and people not doing the right thing. So you might have people who, for example, utilize their super during their non-retired or non-pension age. That's a really, really big no-no. And
people get themselves stuck if they do about the cash.
They take out the money, yeah, unfortunately. So what that means is that if the ATO find you liable of that activity, they do two things. One, they can ban you from being a super fund trustee of your own super fund. So they take the fund, they wind it up, send it back to a reputable fund. Or they might be in a position where they give you a warning, but they end up taxing you at your personal rate for the money that you took out. So you can end up paying almost 90% in tax. Because remember, when in at 15%, you get a penalty of 31% of pulling it out, plus you get taxed at another 40%.
Yeah, true.
All your money's gone, right? So in terms of that compliance responsibility, we do help you, or your accountant will help you making sure that you are compliant. You might have a property agent, a buyer's agent, a fund manager, a financial planner who helps you with the compliance of the purchasing or the investment side of it. So that's important. And we've had, unfortunately, we deal with all different types of professionals. I've had a mortgage broker who's put the super fund name in the name of the members, right? And it's been a really big problem because if you don't set things up right at the start or the outset, you might be in a position where you have double taxation, all these other different things, and that can happen for you. So you do need to have people who are experienced, say solicitors, mortgage brokers, buyers agents, all those different inputs you have, and obviously the accountant. It's important. So we do see a lot of, I think, kind of hospital passes that we get during the course of purchasing. So it's important that you understand that. And I think we do a lot of those transactions for clients. So tax deductions are certainly something that super fund is entitled to, but the management and the costs required to set up and the administration fees you need to manage well, right? So myself and AFIC, we kind of do a joint meeting where we've tried to lower the cost to get in as much as we can because it is expensive, but we've tried to lower that so clients actually can get in. And obviously, if they're entitled to a super fund, sometimes people are a little bit resistant with it. The cost adds up. So we try to do our best with that alongside of Nathan. So any of Nathan's clients do get a bit of a discount with regards to AFIC's fee and ours. We do have to be mindful that you don't want to set up a super fund with $80,000 in it and it's costing you $6,500 to set it up. That's too much, right? That's just our opinion, right? So,
and people setting them up and not being compliant, where there could be double stamp duty, double taxing,
all those different types of things. So, your advisors in the space must be on top of it. We've had a lot of, especially conveyancers, right, as opposed to lawyers. Nothing wrong with conveyancers at all, but it's not the same. So, sometimes we've had conveyancers calls up on the phone blowing up, telling us, "Hey, you need to tell us what to put on the contract."
Yeah.
I go, "Well, that's your job." And they go, "Well, we don't know." And I go, "Well, then why are you taking this job on?" Right. So I think it's one of those things where you just have to have the right people. The last one is really important: limited access to compensation, no fraud protection schemes. And that's true because you and I, if we set up a super fund together, we are the trustees, right? So we're expected to be responsible with respect to what happens. We've had clients who are your clients or my clients who don't want to pay advisor fees, buyer's agency fees, or looking for a quick win. And I unfortunately had one client who transferred over about 100,000, I did 150,000 into a fraudulent account, which was set up in the name of ANZ, and he lost it, right? And he was very close to retirement within 7 or 8 years. And he's basically had to stay at work. So for us, it's make sure who you are investing with, who you are working with, make sure they're all credible, right? That's the reality of it. So I think if you're in a position where you can actually go off and do things yourself, that doesn't mean you do it yourself. And we had the conversation this week about targeted fitness, targeted training versus doing it on your own, and the difference in time, the difference in effect. So we always tell clients that if you're going to buy property, if you're going to do anything like that, make sure you're just doing it with someone who you can trust.
Yeah. Beautiful.
The next one. So leveraging strategies within super funds. So again, for those people who understand the benefits and the risks, obviously, of leverage within their own personal environments, you might have properties that you have in your own name, you bought it, you put in 20%, and you go off and borrow. The super fund is able to engage with what's considered their LRBAs, the correct setup of that, in that same process. And if that means that you are benefiting from that process with leverage, and you are obviously aware of the risk, the super fund is entitled to the same advantages. So again, usually we map it out on the board and we say, hey, if you were to buy a property with leverage, or you to invest without leverage, typically the leverage returns are higher long term, right? And I think you've done 1,000,001 videos on that.
Yeah.
So super funds can only borrow in certain circumstances. They need structures. That's why the super fund is expensive to actually set up. So you need the super fund, a trustee, custodian trustee. Those have to be stamped, unfortunately, in some of the jurisdictions that we work in. So all of those things mean that a super fund is ready to borrow, right?
Yeah.
It basically is governed by probably the lower end of the banks at the moment. Not terrible tiers, but say second and third tiers.
It's getting harder and harder.
It's getting harder and harder.
I actually feel like we could see the day where you wouldn't be able to set up a self-managed super fund.
Yeah, I think that day is not necessarily a remote possibility. I think it's a real possibility. At the very least, they'll start up with borrowing, right? Saying, hey, you can no longer borrow. Or borrowing is reserved for A, B, C, D, fund level, type level, all that other type of stuff. So I think it's important if people are looking to get into the space, you have to take it, it's like we say in tax law, take the tax law as it stands, right? Because it can change tomorrow. It's a policy thing, right? So I think if you're looking at that, once you've got the setup correct, then as it says there, potentially higher returns, access to expensive or more expensive assets. You can buy something for $1 million instead of 200,000. The risks are obviously the same thing that you have in property. So if you've got a property which is poorly chosen, if you've got an asset class which is poorly chosen, you've got leverage in there. The cost of capital is real. You have to pay the banks back. So you need to be in a position that you can cover that off. The one good thing that they've done in super, but the one bad thing for someone like Nathan who takes on equity a lot, is that you can't cross collateralize. So if the super fund grows exponentially because of the properties it has, let's say it goes from 400,000 borrows, now it's got access to $1 million worth of assets, that asset grows to...
You can't pull the equity
out. So you've got to sell. That means that the super fund is always inherently in a defensive position because you can't over leverage it. But I think that's a good thing.
We've got a client at the moment who we bought for like 250. They're selling for like 750, so like 180. So they're going to pull out maybe 550K worth of cash. Spoke to you. They've worked out they're paying 50K tax roughly. They're in the process of selling a property. They're going to end up with They started with like, I don't know, 200 grand. They bought 2 properties.
Probably less,
less than 200 grand. Started off with that. Bought 2 properties. Still own one. One we're going to ditch. They're going to buy 5 new properties in their super fund. They're going to go from 2 to 6. That's cool.
And I think a really key part of that is that there's no lie. Interest rates have gone up. It's a little bit tight for some people in their personal scenarios. They've got lazy capital inside of super. What I'm not entirely sure is that particular instance, but we've got another client who wants to do the same. They actually want to sell a property in their personal name to relieve some cash flow, to have a little bit more of a life back. But they're very set on their goals. And so they're going to pick up that property plus another 2 inside of super, right? So it's a mechanism thing, right? And it's a mechanism that works.
So technically, like we're just talking about super from a high level today, but we're not talking about it on a macro level. When we look at servicing in a super, and we're going to do another follow-up of this on the podcast, and an OBS podcast. If you aren't familiar with that, go and check it out. Google Play, Apple Play, Spotify, whatnot. But we're going to do one with Sumit, who's the head of Zinger Finance. And it's probably a question to ask him. But technically, if someone has a husband, a wife, and 10 kids, right, and they're on 100 grand a year income, and they've got 10 kids plus the wife not working because she's a housewife, so there's 12 of them on one income, and then we've got 10 properties already with debt. That person going to the bank and asking, hey, can I get some money? They're not going to be able to service the bank.
It's going to be a tough day.
But they go to the bank and say, hey, here's my super fund, and they can see the contributions. The bank will lend you still in the super fund. So you may have no borrowing in your personal name, but the opportunity to still borrow in super. You could buy another 2, 3, 4, 5 properties.
Absolutely. And it's just what we're looking at, it's structuring, right, ultimately. So you're effectively taking alternate servicing routes, right? And the super fund is eligible to that because it can borrow. It's getting contributions. So you're in a position where you can actually then go for it. So, but again, probably within the strategy of lending and super, there are risks attached to it. So that's why we do get a financial planner involved, just to make sure that it's all good with regards to your own personal circumstances.
We've got a question in the Q&A asking, what does LRBA stand for here?
Yeah, good question. Sorry to abbreviate because we use it so much. So LRBA is a limited recourse borrowing arrangement. So that's that process that Nathan and I were just talking about how you can't take the equity out and then do another one. So it's limited recourse. So limited recourse basically means what the bank has put in and what you have put into the property. If the property were to go pear-shaped, for example, the bank can't necessarily dip its hand into your super and pull its deficit out.
Can it take you personally?
They've updated all the contracts now where it can, or they can at least pursue you personally. I haven't seen it tested, right? But the notion
tested out, really.
The notion of it is the super fund won't lose out, right? You might lose out, but the super fund won't, right? So So it is one of those things. Good question, and it's something that you need to ask your advisors, financial planners, and accountants to be able to ensure that they understand that process, because it is a complex process. The screen that we've got now is the advantages of SMSFs. So we covered this earlier on. So using the phraseology concessional tax rate, I don't love it, to be honest with you, but it's what comes off the ATO and all these other different sites. The super fund is taxed in a lower environment because realistically, it's the same notion that the government might reduce tax in your own personal environment. They want you to keep more, to invest more, to grow more, right? Now, people become hyper paralyzed with tax, as we've spoken about. Tax typically in your personal name globally won't go down. My view is that super funds are tracking in the same way. As I said, it's a big bucket of money, 4.1 trillion. They will start to try and tax this more and more. If you earn over 250,000, they do tax it more. You get Division 293, an extra tax on your super contributions. You end up paying basically 30% on your super contributions.
There's always a gatekeeper.
There's two of them.
Yeah.
So in this instance here, you've got the ATO in your personal environment, and you've got the ATO on your superannuation environment, right?
It's always a three-letter institution. ATO, CIA, FBI. There's always a three-letter one that serves the gatekeeper.
So here we've got another three-letter one, which is CGT, so capital gains tax. The super fund gets long-term capital gains tax are taxed at 10.3%, which is really, really good. I suspect that will go up. I suspect tax at some point in the pension phase will go up to about a 10% rate. They will try and tax that because at the moment pensions are considered tax-free. I don't think they'll be super aggressive with it. They might just bring up the capital gains tax rate. Tax deductions in the super environment are absolutely everything that you would get in your own personal name when it comes to property. So council, water, strata, repairs, maintenance, property managers' fees, any other fees that you might have in regards to holding a property. It does get some additional tax deductions that people often overlook. Insurances can be paid out of super, so it's a little bit more tax friendly, whether it's income protection or otherwise. Income protection is typically in your own name, but life TPD can be paid out of super, which is good. For a lot of people, it's being paid out of their retail super funds. And the big one, obviously, the Cayman Islands play is tax-free in retirement phase, right? So you don't get that anywhere else in Australian tax environment. Zero tax under current legislation. Everyone expect that to change over at some point. They are bringing in trying to bring in a very regressive tax, Division 296. Nathan, you'd be mortified by it, which is basically if your super fund goes over a certain balance.
3 million.
3 million is a number now. They're thinking about dropping it to 2. They tax you on the unrealized gains of your super fund. So in share world, it makes sense. Today, BHP is at $20. Tomorrow, it's at $60. That $40, if it happens to be over the limit, they tax you on that, even though you don't really have it, right? So it's a pretty ludicrous tax, in my humble opinion. I'm generally pro-tax, but over the years, Nathan's whittled me down.
Come on, you don't want everyone to bash you. Come on.
But a unrealized tax on amounts that you have in your super.
That's fucking disgusting.
That's putting.
He's very politically correct, right?
That's not a friendly one, I don't think. It's probably right up there with payroll tax, in my humble opinion.
payroll tax, land tax. Like, if it was your property and someone came along and just go, oh, well, I'm here, I'm just going to take your car with me today. Thanks a lot for that. You pull out the gun to shoot it, right?
Yeah.
And it's like, we're not violent people, but like, it's just something that happened, right? But it's like, this is always the gatekeeper. There's always the gatekeeper. We'll just talk about the ATO. OSR's waiting there for you, right? Your land tax, your OQR or whatever it is, QRO.
Yeah.
You say they're just.
We don't.
I've got a rant.
We know. We don't want to get off track.
No.
So, I think it'd be a really good time now if anyone had any questions regarding self-managed super fund. Obviously, kind of go through this at the end. We'll recap, but if you do need to have any conversations, questions, Nathan himself has a super fund. I have a super fund. We deal with tons of clients who have super funds. So
if you have 6 figures and you don't have a self-managed super fund, you're doing yourself a disservice, in my view. As a humble investor, not as your financial advisor, because I'm not a financial advisor.
100%.
Exactly.
But it's certainly worth having conversations. We'll put you in touch with our financial planner just to make sure it's right for you. And if it's not, it's not. But if it is, then something you certainly can consider. But definitely make sure that if you're thinking super, you're thinking about protection, all the things that we've gone through today, like we haven't even gone through some of these. As there's customers were told, do your what's it called, authentication process, your MFAs, and the money was taken. So just be aware that it's your money. You've got to look after it. You've got to make sure it's going to be there for you.
I think that's what a lot of people don't realise, is that if you've got $250,000 and it's sitting in a super fund, that $250,000, who has it, right? What decisions are being made? You have the ability to go and take that and use it at your discretion to do what you would need.
Yeah, within the super environment.
Got a question here. Here's a couple here. This one, the first one, I'll answer this one. Just got asked, can you convert a defence super fund, military super, into a self-managed super fund once you finish working with the ADF?
So the short answer is probably not, and the reason for that is a good one. So it's very important that when we go through the process of considering a super fund for clients, we look at the actual makeup of where the super fund's coming from.
Is it a lot of defence?
Yeah.
Is defined benefit?
Yeah, which are really fantastic funds because they effectively continue to pay you and then commute to anyone that you leave, and they don't go backwards.
I have seen newer ones which aren't defined benefit when it does come to military. So it's important to check it out. I've never seen any advice for anyone to ever take a defined benefit and roll it over.
Correct. It's pretty much a no-no, right? So, but it's always the case where sometimes the ex-servicemen change jobs.
Yeah.
And
they've got another bucket.
They've got another bucket, right? Yeah. Exactly right. So the military super might be frozen. They might set up another one.
Some military are not defined benefit though.
Yeah, so some of the new ones, but it's important you get the advice.
What I'd suggest is to reach out. There'll be contact details or QR code or email us or whatever, and we can get someone to have a look at it for you. Here's one for you. Can I assume you can't buy a property 50% in your super fund and 50% in a trust?
Good question. You actually can, but it's not the fact that you're buying it in a super fund in a trust. It becomes a partnership, effectively, right?
Yeah.
We wouldn't recommend it. We try and make sure that the super funds are purchasing properties within their own sphere or ambit individually. You can actually JV with your own super and buy a property. So it is possible, but you're trying to reduce complexity as opposed to increasing complexity. But definitely something that we can do. But the super fund is allowed to buy properties with someone else. But where it becomes complicated, just as a shortcut, is when you get debt involved, right? Yeah. So if you've got enough in your super fund, you've got enough in your personal name, you could join forces and buy it cash. You could join forces and do a number of things, but then you've got to look at your capital allocation, right? Are you using it the best way?
Yeah. Josh asked here, what is the minimum you would recommend in a super fund before opening one? The answer to that is how long is a piece of string? Right? There's some government regulations around there defining 200,000 as the entry level into a self-managed super fund. We've seen people come to us and they set up one with 30,000, not with us, but they'll just set one up with $30,000, and it's like you've just really screwed yourself. It's like scammers do that sort of stuff. Have seen people that have successfully set them up with $100,000, but they've had other parameters. They're a sophisticated investor. They've got other things going for them. So I know the person that wrote that message, Josh. In your situation, he's a sophisticated investor.
Yeah, I know Josh. Yeah, lovely guy. So yeah, definitely something we can have a chat about.
What we've got here. Monica says here, if you had 250 grand of super, how many properties could you buy potentially? Do you need to keep the property at a certain LVR? And I saw that with two other people at question. I think Wayne had asked that as well. Each bank is different. The lending in your super is very, very high, very vanilla deals, and they shade it very aggressively. So they will put a lot of clamps on what you can lend and what you can't lend. Nothing under 50 square metres. Capital cities or large regional areas, if Macca's and Bunnings aren't there, they won't allow to it. Then the sizing of the property, and then how many units are in the complex, whatever the case may be. So generally, you get up to 80% LVR. Sometimes the bank will say we're only give you 50% LVR, but there is a lot of products out there that, well, there's only about 2 or 3 products in the market. There's not many lenders that will allow you to borrow on that. So if someone had 250K in their super and you borrowed at 80%, technically, you could probably buy up to about $1 million worth of property, right? So if you're buying 200 grand properties, that could be 5. But do bear in mind that the bank's lending policy means you need to have a capital reserve of liquid funds, so a liquidity buffer in place, which would be about a 5 or a 10% buffer of what the property or the value of the asset would be worth. And that could be invested into shares or crypto or gold and silver or whatever the case may be, but they want to see if there is liquid outside of property investment. So Ritual says here, hey guys, if we borrow in our self-managed super fund, does that eat into our borrowing capacity in our personal name? No.
Typically no.
Yeah, it is based on the super fund itself. It is isolated. That's what I was saying before. And if you had 10 kids, 10 properties, 100 grand income, the bank wouldn't touch you, but you've got the income coming into service, self-managed super fund, they would still lend on you. He says here, what is it?
Quickly on that one, what we received from Emma is that if you had 250K in super, how many properties you could buy? It's a good question, but sometimes, and I get a lot, how many?
Yeah.
My question is that even if it was 1,
yeah,
the outcome is the same, right?
Yeah.
So whether you buy 1, 2, or 5, right? You're still using that leverage theoretically, right? So that the gain or that perceived increase or excess returns that you could get still present, right? So sometimes clients want to work out the long-term view of that end arc, which is good, and you kind of miss the first part of that stopping zone. So I'm not saying that you're doing that, but certainly it's considering that even if you were to get 1, it's worthwhile as a discussion to understand how it works.
This one here doesn't have a name, it's just a K. Says, what are the key responsibility and risks I need to be aware of when managing my own self-managed super fund, and how do they compare to leading super in a retail industry fund?
A really good question. Probably the first 15 minutes, what we go through in our sessions is the responsibility change or the responsibility risk that you have. So in a retail super fund, like these 4 people had, they only found out probably when they checked or they were contacted, for example. So in a retail fund, a lot of people get that quarterly statement, just throw it in the bin, don't open the letter, don't open the mail in the mailbox, for example. And, you pick it up and it's got snails eating it and everything like that. And it shows that you've got 160,000 in there and you go, okay, whatever, you throw it in the bin. So with a self-managed super fund, you need to be on it. You have access to the bank account. That bank account access is restricted. You can't do anything other than pay for super fund obligations. And each and every year, someone like us, our administration team would contact you and they would say, hey, Kay, we've got your bank account that we can see at Macquarie Bank. You spent A, B, C, D on these transactions. We need all the invoices. We need to know everything. It's audited every single year for me, which is a fantastic thing because it means that you have to be on top of what you're doing. So it's not a set and forget.
If there's a Mad Max and cold on the research,
you're in trouble.
I don't even eat Mad Max. I've never tasted it. I think I tried it once or something. It tastes disgusting. Here's a good one. If you own investments in privately precious metals, for example, gold, silver, can you convert it from private ownership to your self-managed super fund, effectively buying it from yourself?
So the short answer to that is generally no. You can't buy assets from yourself, but you can buy assets from your super fund, right? So if your super fund owned a property and you wanted to buy it, you can actually do that as long as you're buying it at market rates. But typically speaking, purchasing items from yourself, they do not allow, right? But you can go buy it from somewhere else.
If someone had a friend that owned some metals, they could buy it from the friend, possibly.
So I'll be completely frank, metals there is a exemption, right? So you can actually, if you do everything right, so if your metals are held with, for example, a metal vault, and it's actually what's it called? Valued, and they tell you exactly how much is in it, and we can work out that exactly the same, like for like, what you're buying, you can actually do that transaction, because it's one of those categories. So we have had a couple of clients who have done that.
Ben asked, when setting up a self-managed super fund, does the fund finance setup, or do you need to cover the cost of this personally?
So the way that we do it in our office is that you actually pay us personally, but then the fund reimburses you. So ultimately, you're reimbursed by the fund, but just from a commercial point of view, we're paid, and then once the funds are rolled over into the bank account that you then control, then you reimburse yourself for the exact amount that you've paid with respect to the super fund.
And Wayne just asked again, is that only for resi or commercial?
No, commercial as well, absolutely.
What's that?
Purchasing?
I know, yeah, you can buy whatever. I think you asked about the LVR beforehand.
Oh, right, sorry.
If it was about the LVR versus resi versus, it would be similar to what you'd be buying under your personal sort of capacity, 70%, 80%, 60%.
Resi is generally between 70 and 80% of what we've seen. And then, as Nathan said, commercial can be, depending on the type, depending on the risk, et cetera, that might be 50, 60%, if it's really risky, 40%.
So as a bit of a backup, keep the questions coming, folks. We've got an extra part to tonight's presentation, and that is talking about trusts and understanding how trust works. Because a lot of people, that's the super fund, but there's other special purpose vehicles that you could have, which you could use, and the benefits of them. Not so much go through.
Look, we have done trusts before, but it's now again flavorful. We've been doing trusts for over 10 years. Clients use trusts for various different reasons. Trust comes in various different forms, different timings. When you die, you can have a trust set up on your death to be able to carry out your wishes. There's a whole bunch of different reasons. Typically speaking, you will hear the terminology family trusts, unit trust, discretionary trust. We won't talk about hybrid trusts tonight because they're difficult beasts to tackle when it comes to the ATO, and it's typically not for everyone, but they certainly do exist. Trusts for investment properties, I'll get the first thing out first. Is that for the last year, everyone's been talking about trusts and serviceability. It's something that can change at any time. So I had a conversation with a client today who essentially was thinking about purchasing property purely based on tax policy, negative gearing, for example, right? And I said, look, when Bill Shorten was coming into power, or he was going to win that election in 2019 or whatever it was, he put negative gearing on the chopping block. I'm not sure if you remember, right?
Every election it is.
Oh, not really. Yeah, I mean, look, that was a landmark policy, right? So they wanted to tackle housing crisis through that. Scott Morrison ended up winning, and the rest is history. But if you buy a property purely based on tax policy, be aware that tax policy can change, right? Now, the same is true of these trusts. Banking policy at the moment is dictating that trusts have a pathway to lending where if you are maxed out or you're at a sort of tight position in your personal name, if you open up a trust and that trust in and of itself has nothing in it, they kind of allow you to have a little bit more flexibility with your lending, and you can actually get a property or you can get some lending or serviceability inside of your trust. That could change tomorrow.
Right? We're going to do a podcast on this with Sumit from Zinger Finance. And the reason being is that it depends on your position. Like we could do hours and hours and hours about trust or personal name or whatnot. And there's pros and cons, right? I've seen investors where they can't service under their trust because the add back. So if you have any tax benefits or any depreciation that's there, that could go back to your cash flow to help service. When it's the trust, they cap it off and they don't bring that into your serviceability. So it can actually hold you back. Not all banks will allow the trust structure to work. Some banks won't. So there is benefits to it, and it depends on each individual's circumstances, position on their journey, and what they're sitting at. Yeah.
And I think even my own personal engagement with trust has evolved over the years that we've been doing this. We were probably a bit more resistant to it, I should say, earlier on.
Because the products wouldn't allow for that.
Correct.
Yeah. The products today
have evolved. Yeah. So just as a general marker, we kind of, Nathan and I, basically get clients to consider all options, consider all structure, elements that they have. If you have your personal name and you have a super fund and you have a trust, as we kick off the trust conversation, and you are buying one property, maybe one and a bit properties every year in each of those environments, pretty quickly you get to 10, right? After 3 or 4 years, you're sort of at 10, right? Because the super funds might have a little bit more freedom at particular points. The trust might have a bit more freedom at particular points. And then the banks, like CBA called me, they go, hey, if you've got people who are self-employed, Ridhwan, if you sign off that they've got XYZ and you can see it in their bank account, then they get around to lending, right?
Yeah.
So you have to be kind of also personally able to evolve with the environments that you have around you to be able to do it. But that's more the situational environmental. In terms of a trust, what you can see on your screen, predominantly and historically in all the corpus of works that you see, asset protection, tax planning or tax income streaming is the main reasons with regards to trust. The big one that everyone forgets is estate planning. So if you've got a position where you can actually go off and control your future generations from the grave, the trust can help you do that.
Yeah.
Nathan might say, I don't want my children's partners to get anything. I only want my children's to get something. And when that youngest child turns 18, bloodline trust, for example, that youngest child turns 18, then you're in a position where you can actually access the trust. Now, certain things can always be changed, but that's the idea. Flexibility and control, especially with discretionary trust, is true, but they do have some pretty significant downsides, in terms of some of the tax elements. But as you said before, sometimes you've got to pay to sit at a table, right?
Yeah.
So it's one of those things. So typically speaking, trusts with specific relation to investment properties, they're used to be able to put that property inside of a vehicle, which it's difficult to get out, right? If you get sued, if you have liability risk, if you've got divorce, all these other different things, the trust may shield you from that.
Yeah. And I guess this is something that's never really spoken about. There's different ways, right? It's not something that Ridhwan can give you the advice on for this one. And it's not something a lawyer could give you the advice on, because there's ways around it, right? But let's say, for instance, I own a property for 200 grand and it's gone to 500 grand, right? I owe 200, it's worth 500, got 300 grand in it. If someone was to sue for that property, there's 300 grand worth of equity in it. If someone successfully wins and you're like, hey, I want to protect myself, what about if you had a second mortgage to a trust that's owned over there under that entity, right? If you have a trust and I have a loan to you, how's it going to affect any legal proceedings and what would happen with the flow of funds? So I guess there's ways after the event where you could build, this ain't giving legal advice or tax advice or structuring advice here, but go and take the advice from a lawyer and get the advice that you need. But if there was second, third, fourth mortgages came in, slapped up the eyeballs on it, someone's going to take and then screw you over, they're going to have to go and sue you. Then they have to sue you and then sue through the bank. The bank has an interest in the property, so then the bank has to make a decision. But then if they successfully sue through you and then sue through the bank, and then there's money left over, no, they have to go and sue the second mortgage, right? And then successfully win to them. And then whatever's left over, they have to sue the third mortgage.
Yeah.
They're different.
There is structures, equity protection structures like that, which exist.
Yeah.
But probably a more real example is that, well, not more real, that's a real example. But one that I know of is that client had really good business. He sold that business. The business is in his personal ABN environment, which worked out from a tax perspective. He had $5 million in his name, and he was a professional. So he thought, okay, if this is in my name, it can be a problem.
Yeah.
We can't give it to your wife because she can get sued. You can't give it to your kids because they might blow it up on, drugs and parties.
Yeah.
What do you do with it, right? So we ended up basically creating a trust, gifting that money to the trust. Then you have a 4-year window where there's no activity from legal perspective. Then that trust and that gift become irrevocable to him, like he can't take it back, right?
Yeah.
Then what he had to do is what he had to then take a loan from the trust. So actually, he went from an asset position, a strong asset position, then de-levered out of that asset position into the trust, then re-levered out of the trust, got the money back, but it's actually not his, it's a trust. So if anyone came to sue him, the trust actually is going to pull that money back. And so that's how you can sort of protect some of that cash that you have, but still have access to it.
Different types of trust?
Different types of trust. The main one that you'll hear is discretionary family trusts. The two are used interchangeably. They are slightly different in terms of family trust needs family trust selections. You can't distribute outside your family network then. But all that notwithstanding, discretionary trusts allow you to effectively distribute income to people within your network, whether it's bloodline, family, whatever it might be. Under certain conditions, you can distribute more than say $5,000 to them if it's not a franked dividend. And you might have the really obvious one, a bucket company. Yeah. So companies in Australia are taxed at 30% if they're coming from passive sources. And then if you're in a position where you are looking at buying something in your name, it's cash flow positive, or you have some sale event, for example. If you don't want the money in your name, you don't want it to be in Nathan Birch or Ridhwan Hannan's name, but you want it to go to a tax-friendly environment, you can distribute to a bucket company, pay 30% tax. Yeah. That bucket company can actually become your little bank. Yeah. You can then, for property purchasing reasons, borrow from that, right? Yeah. When you borrow from that, then you can obviously go to the bank, you can borrow from the bank, right? So that's where you see a lot of professionals or high income earners or high net worth individuals, when you look up on title deeds and stuff like that, it's a company name which owns the property. So sometimes the company is either purchasing that property because they've got bucket money or bucket funds in there effectively, or they're borrowing from their own bucket company to be able to go off and do. So they end up financing themselves. So it's a really useful way to be able to basically cap your tax, no matter what your income is. You can put it in there, and in retirement you can actually draw that money out and live off the dividends that you might get from it. So super useful. Discretionary trust. Second point there, trustee has full discretion on income and capital distribution. That there sometimes sort of veers into the hybrid trust world, but typically speaking, income is income, capital is capital. We define those two and then we distribute accordingly. Beneficiaries are generally and usually from family members. Obviously, any beneficiary who is distributed income, they have actual legal rights to it. So don't just line up your whole family all the way down to Uncle Sam, because they can actually ask you for the money.
Yeah. Very, very important. Very important.
Discretionary.
You've got a loaded dog there, and then suddenly they're blown up in front of you. So,
discretionary trusts have some drawbacks, without a doubt. So we've gone through the pros: tax minimization, flexibility. It's not immediate tax minimization, but the flexibility to it. Asset protection is a big one. Simpler to manage than unit trusts. Yes, they're also more asset protective than unit trusts. Very common misconception that if you own properties in via a unit trust, they're protected, but they're not. Yeah. And the reason they're not is that you own the physical units in that unit trust, like owning shares. Yeah. Still an asset you can be sued for, right? The big pro here on this side of the arrangement is that you are in control, right? Yeah. You as a trustee are in control. That's the main thing. The cons here is that losses cannot be distributed, and that I can't overstate how important that is. I had a client with losses in their trust for many, many years from a different advisor who set up a property in Queensland in some sort of apartment block.
I've seen so many of them. The worst one I ever saw was someone owned no property, just one block of land. The block of land was owned under a trust, and it was in New South Wales. So there was no income, there was a mortgage attached to it, they were copying costs every year, there was nothing they could offset because, and then they were paying land tax on the thing because there's no land tax threshold, but if it was under their personal name, they would have had...
Yeah, it's a big one, right? So a lot of people don't realise that you have land tax. Man, I've had the worst case, lovely lady, she's awesome. She got told that having a principal place of residence inside of a trust, discretionary trust, would be the best thing. She ended up paying land tax every single year, had 150k land tax.
Capital gains tax.
Sorry?
Capital gains tax.
Capital gains tax on the way out. Oh man, it was just horrific. So, make sure it's the right thing for the right reasons. So definitely. Unit trust, beautiful one. I love unit trusts because they allow you to do a number of different things. You can split up, you can have joint ventures. It's very defined, still operates the same way as a trust. If you have a property with inside of a unit trust and you're the whole beneficial owner of those units, you have to transfer it to yourself with notional stamp duty, so it can be very useful. And that is something that is considered, often used by unrelated parties investing together. It's a really big one, the middle one. So if you're thinking about buying a property with mum, dad, sister, wife, brother-in-law, father-in-law, friends, best mate, utilize a unit trust, much more defined, much more strict than partnership or just joint venture, and certainly something that you can use to purchase properties with someone and over time purchase back from them, right? So if the property is less than $2 million, then stamp duty at the moment still is exempt from the property value. If it's over $2 million and you still have to pay stamp duty on the transfer of those units, they are changing that though. So, but still something that's very, very usable, flexible. But the big cons of unit trusts is, I think on the next screen, is that you cannot tax plan for them because whoever owns the units gets the income. Bank lending may be more favorable than discretionary trust if the units are clearly defined and held. I think that's been to say less favorable. So they can be, so unit trust, for example, because you own the physical unit, they can then ask you for your serviceability.
Yeah.
That becomes a problem, right?
Sorry.
That's all right. Pros, easy to determine ownership and share sale, very, very good. Fantastic structure in that regard. Allows capital distribution through the unit trust. And for example, if you own a business and you're trying to draw up profits, if it's in a company, you've got to take it out as what? Drawings, dividends, wages. In unit trust, it's free flowing capital, no superannuation on top of it. So really, really useful in that way. So a good way to trading unit trust is a really good way to own a business, actually. Financing property in a trust structure, bank's view. Okay, so big disclaimer, this is Sumit's world, right? So I'm just doing what I can, and Nathan's probably doing what he can.
From Zinger Finance.
Sumit's the head of Zinger Finance, lovely chap. Yeah, I've got a lot of time for Sumit, so if you haven't used him, absolutely do. Typically, assess the serviceability of the trustee or guarantor. Now, that's what's become a little bit up and down, topsy-turvy. They actually make you a guarantor, but they don't assess your servicing. So they back end you to be on the hook, but they don't actually see whether or not
they put a claim on.
Yeah, it's kind of that way at the moment. Again, it could change, but at the moment, that's what everyone's talking about. Every single buyer's agency podcast is about unit trusts. I mean, sorry, in terms of discretionary trusts.
Why they're talking about this stuff is because the properties that they buy are shit and they're negative cash flow, so that impact your servicing negative, which isn't a real structure, a real strategy, and you're just creating little landmines. If it's negative, you're holding off the balance sheet, which...
Yeah, look, I had a client today who I spoke to who bought 3 properties off you, I think. He's at the point now where all 3 properties are positively geared. So if you had that in a unit trust, for example, the bank on the second purchase, so you purchase property 1, all good, maybe have it for 6, 12, 24 months. If that's positively geared and the unit trust is looking after itself, so the unit trust is cash flow positive. So theoretically, the second purchase inside of that unit trust gets through with the same serviceability requirements, right? So typically speaking, at the moment, if an accountant will sign off or a financial advisor will sign off, the trust is looking after itself, i.e. its costs are being met by its own rent, then the bank goes, cool, well, we can utilize this again, right? So you might be in a position where you can get 1, 2, maybe 3 properties right inside of a unit, inside of a discretionary trust, or inside of a trust, I should say, where even if your serviceability is a little bit tight on your personal side, you can keep running through those hoops. Financing property in a trust structure, advantages, can separate risk from personal holdings. That's absolutely true. So may improve eligibility if personal borrowing is maxed out. That one has a bit of asterisk next to it, but the first part of that can separate risk. So if you've got a property which you're not sure of, risky, you bought with someone else, all these other different things, you can contain, or you can basically keep that and have no contamination risk come outside. The unit trust blows up, bank takes their money, you take your money, it's all gone. They won't be able to search outside of that. The big caveat to that is if they make you a personal guarantor for it, then any losses that banks may incur, you might be up. So be careful about that. Financing property inside of a trust structure, tips for investors, have clear trust deeds and documentation, super important one, right? If you have bespoke trust deeds, I had clients asking me, hey, can I make my own trust deed online and then replicate it? So I wanted to pay for the unit, for the trust, for the documents. I was like, yeah, okay, it probably cost you 10 grand anyway, which is fine for us. But if your deed is not kind of boilerplate enough, and the bank's legal team has to go through the whole thing every single time, it's going to be a waste of time for you. So absolutely, it's a really good point. Work with brokers and accountants experienced in trust lending. That's important as well, because sometimes you'll find that an accountant will go, yeah, it's asset protection, but it's negatively geared to the hilt. And we just talked about that, right? So it can be really bad, right? Consider company trustee over individual trustee. I would say never consider individual trustee anymore. The cost of setting up a company is so reasonable now. Always go corporate trustee. Means that if you die, partner dies, liability occurs or anything like that, you can kill that trustee, change it, move it, upgrade it, transfer it, whatever it might be. Conclusions and next steps, and I apologise if we've been going on for a while, but Nathan and I can talk about trust and property all day long.
We haven't even talked about all fun things
we haven't yet. So I think there's a podcast of us coming out, so we can be a bit more relaxed about that one. Conclusions and next steps: evaluate if the SMSF or trust suits your financial goals and capabilities. Look, with the super fund side of things, first port of call is to speak to myself or AFIC, and more importantly, AFIC, because he's a financial advisor who can basically give you that rubber stamp to get going. We then run you through all the bits and pieces with regards to what it actually looks like on an operating point of view. Trusts are much more simple in terms of setting up. There's no real governance required for the trust setup, as long as you're aware of the risks and the pros and the cons that we've gone through tonight, and you speak to someone like Nathan or Nathan's team, for example, and they say, hey, this one will be positively geared, if you're having a service arrangement, or you don't want to have this property taken outside of your pool of properties because there's risk in your own personal name. Trust can be beautifully set up and pretty easily. Use the ATO and your accountant on one path to help. So the ATO's got really good resources, to be honest with you, online. It's been made much more friendly. You don't have to be an accountant or lawyer to look at it. We're more than happy to help you. We have tons of chats with clients where we don't do the work, so they're with other accountants. And to be honest with you, for me, if you're going ahead in your journey and you're doing well, and you've taken ideas from us, so you've had a positive engagement with us, and you've gone off and bought 10 properties, it's good for you, right? It's really, really good for us. So yeah, definitely we can help in that regard.
Beautiful. And I guess the next one's over to questions. There's lots of questions in here. I'll leave the questions for you to go through. And just in the meanwhile, as we're going through questions and answers, you got the QR code.
Yes.
Take a photo of the QR code if you're not on your phone. Email. Reach out to the team. Have a chat with Ridhwan. Have a chat.
I'd love to help. And, we are always busy. It's busy because we do a lot of work. So if you ever don't hear back from me, brute force call, message, same way I do to Nathan. So you just got to get through. So we'll go through some questions now. And thanks everyone for listening to me for so long. But I'll try and get through these questions. Aside from the legal securities and positive borrowing capacity of a trust, for a standard family of 4, does it work out more beneficial financially to purchase property through a trust or through personal names given the choice? Look, I don't think it's an either or. I think you have to be aware that the property type that you select, where you select it, state-based, for example, can make genuine financial changes whether you buy them in a trust or your personal name. So for me, if you're looking at properties inside of New South Wales, properties are expensive in New South Wales. Land tax is a big one. So you might be in a position where you go, hey, I'm willing to wear the risk of it having outside of a trust to not have to pay $30,000 in land tax, those type of things. So I think what you need to do is sometimes in tax or sometimes in this property space, people say either or, right? It's not really either or. It's about a question of timing, appropriateness, and when that is going to suit what you need to get to next. And that's how we always think, what are you going to do next? Getting property 1, 2, or 3 is fantastic. But if you want to be a property 9, you need to have that pathway a little bit, more flexible than an either or scenario.
What do I need to get the job done to get to the next level of the journey? And that's what I'm always thinking of.
Yeah. And that's true for you. You're always buying something which is it's nuts, right?
I send him deals every day. I'll buy this, I'll buy this, I'll buy this, I'll buy this, I'll buy this.
Okay, let's work through this one. Wayne's got a question. To change percentage ownership in a unit trust, increase percentage for and decrease another, do you pay stamp duty for the percentage change? So good question. So as per the legislation, I've got to refresh because I haven't done it for a little bit, but up until probably 2023 or 2022, if it was under $2 million, then no. But I think they were updating that where they were going to try and catch everyone to be in that. So effectively, if you've got a unit trust and someone owns 50-50 and then someone wants to go to 60-40, if it was under $2 million, there's no stamp duty on that change. But if it's above $2 million, then you have to value it, and the cost of the stamp duty proportionally to what you change is applied. So it can be quite complicated, but I'll have a look at that and make sure that they haven't updated that. But under 2 mil, it was the case where you didn't have that provision.
Here's a question for you, Ed. Bucket companies, do you have to have a director? And is the director ID still required for directors of companies newly set up?
Yes, they do. So all companies need a director and a director's ID, and one director has to be Australian. So you can't pick up someone from overseas and say, hey, he's my director. It has to be local. So
I've got a question. So when you set up a company, like if you haven't got a director ID, like what's that process? Like, do you have to, like, how does it?
Well, you can still set up a company without a director's ID, but ASIC gets notification of every single director. They then map that back to the director's ID portal or register, and then very quickly you'll be sent a notification from ABRS saying that you need to set it up. And if you don't, there's a $14,000 potential fine, right?
Yeah.
So we would recommend just setting it up. To be fair, they know everything about you as is.
So there was another question from that person that asked that. I'd probably suggest that it'd be a discussion to have with the team, like it's more delving into personal and private sort of questions about your position. Do a essay, who you are, ask that question. Just it's not a question from here, but we can answer that. Josh here says, is there a recommended amount of properties that goes into one trust, one property per trust, or should you do multiple properties in a trust?
Well, I don't think you should do one property per trust, but a lot of advisors say it. I just don't think the mechanics or the admin is worth it, because setting up a trust is not inexpensive, not super expensive, but it's not immaterial. And then managing a trust, looking at $1,500 to $2,000 a year. So if you had 10 of them, that's 20,000. Kind of a lot of money.
You're lining the accountant or person's pocket.
I'm doing myself out of fees, but I work for you guys, right? So I think that have multiple properties inside of a trust. You might get to a capping point where you go 5, 6, or something like that, and then you set up another one, something like that. And that might then have you a little bit of diversification risk managed as well. So I think, Josh, you can have multiple properties in a trust for sure.
Yeah. I've started going with serial numbers, so just having them with like a serial number attached to it. So it's like number 1, number 2, number 3. So it's like you can package them into little packages. If I look at my journey, I've gone, I'll just run under this one. I've made trust with the most obscure names attached to them.
Believe me, you see his trust folder bookcase. Oh my God.
I can't even fit them all in the bookshelves, right? There's walls of these things. So, but yeah, it's cool. Awesome. Well, I think that's it. We should make it a wrap. We're almost 2 hours here, 1.5, 2 hours here today. Thanks a lot for everyone tuning in.
Thank you very much.
Having us as a part of your household on a Tuesday night. If you do want to get in touch, details are there. Take a screenshot, take a photo, scan the QR code, book a chat with one of the team. Happy to help out where we can. Thanks a lot for what you do, Red.
Thank you for having me. It's always a pleasure. It's always a good chat.
Get the podcast happening soon. And thanks for watching. We'll catch up soon. Have a good one, guys. Bye for now.
Take care, guys. Bye-bye.